You downloaded the no-fee investing app because you're trying to be responsible. You're doing the right thing, right? You're starting small. You're watching every dollar. You're proud you're not paying an advisor 1%. You're proud you're not paying commission. And yet, your account keeps leaking. Not because the market hates you, not because you started too late, not because you don't make enough money. It's leaking because the cheapest looking strategies often come with the most expensive invoices. And those invoices don't show up as a line item. They show up as years of extra work. They show up as delayed retirement. They show up as that quiet sentence you say to yourself after a bad week. Maybe investing just isn't for me. So let's stop that today. If your low-budget strategy depends on any of these things, frequent trades, concentrated bets, headlines, leverage, or the hope that you'll magically time your way out later, you're not investing on a budget. You're investing without insurance. Benjamin Graham had a word for that, speculation. And he wasn't saying it to sound superior. He was saying it like a doctor reading a lab result. Matter of fact. Calm. Because the goal isn't to be brilliant. The goal is to be unbreakable. Here's the paradox that changes everything. True low-cost investing is not the same as cheap investing. Cheap investing says, what's the minimum I can do? Defensive investing says, what hidden costs can destroy me, and how do I design them out? In the next few minutes, I'm going to hand you a one-page defensive investor budget. It's not a spreadsheet. It's a way of thinking. You'll know exactly where your money has been quietly bleeding: fees, taxes, turnover, bad timing, value traps, and panic. And you'll know the simple structure Graham used to make the market a servant instead of a boss. But first, you need to see the invoices. Picture a normal investor. Call him Mike, middle class. He's got a 401k at work, a Roth IRA he contributes to when he can, and a taxable brokerage account he calls his Freedom Fund. Mike is smart enough to avoid obvious scams. He doesn't think he'll get rich overnight, but he's still getting charged. Not by a bank teller, not by a bill in the mail, by friction, by emotion, by the wrong definition of cheap. Invoice number one is the one nobody wants to talk about because it feels small. Trading friction. You were told commissions are gone, and for many brokers, they are. But zero commission never meant zero cost. Every time you hit buy or sell, there's a spread between the price you can buy at and the price you can sell at. There's slippage. There's the cost of impatience. There's the cost of being nudged into more activity than you planned. And activity is expensive, not because the market punishes movement, but because movement multiplies the number of times you can be wrong. Graham's defensive investor isn't passive because he's lazy. He's passive because he's realistic about the odds of outsmarting a crowd that includes institutions, algorithms, and people who do this for a living with better tools than you'll ever want to pay for. If you are trading because it feels like doing something, you're paying with the most precious currency you have, your future compounding. Let's make it concrete. Imagine you invest $100,000 over time and the market gives you a solid long-term return, say 7% per year before all the little leaks. Now add a small annual drag, 1%. That could be higher fees, bad products, churn, poor timing, or just the cost of always fiddling. At 7% for 30 years, $100,000 grows to about $761,000. At 6% for 30 years, it grows to about $574,000. That small 1% leak cost you roughly $187,000. That's not a rounding error. That's a college education. That's a chunk of retirement. That's years of your life. So when someone says fees don't matter, or it's just a little spread, or I'm only trading a little, remember, compounding is a machine that amplifies whatever you feed it, returns and cost. Invoice number 2 is the tax invoice, the one that shows up only after you thought you won. This is where low budget investing often becomes high tax investing. People chase short-term moves because they feel efficient. They love the idea of taking profits. It feels like being responsible. But when you treat your brokerage account like a slot machine, small wins, constant pulls, you create taxable events. In the United States, short-term capital gains are typically taxed at ordinary income rates. Long-term gains often have more favorable rates. That difference isn't a political debate, it's math. Graham didn't have to speak in modern tax code to understand the principle. The market gives you enough enemies already. Don't hire another one. If you're investing for retirement, the order matters. Capture the 401k match, understand your Roth IRA options, and think before you dump long-term assets into a taxable account that you plan to churn. The point isn't to become a tax lawyer. The point is to stop donating your compounding to the IRS because you couldn't sit still for 12 months. Invoice number 3 is the one that sounds like being disciplined, but often isn't. Over-diversifying the wrong way. A lot of people hear diversification and think the budget move is to buy a little bit of everything that's trended. 5 AI stocks, 3 biotech moonshots, a crypto trade, an EV company, a next Amazon, and a semiconductor name because everybody on Finance YouTube said it's the future. That's not diversification. That's a collection of correlated stories. Graham's version of diversification wasn't about owning more tickers. It was about reducing the probability that a single mistake can permanently damage you. He was trying to protect you from the kind of loss that changes your behavior forever. Because here's a truth every veteran learns after a big loss. You don't just lose money. You lose trust. You lose time. You lose the willingness to keep going. And if you lose the willingness to keep going, the market wins. Invoice number 4 is the most seductive, the cheap stock invoice. This is where the title of this video becomes painfully literal. A lot of low-budget investors believe the best strategy is to buy what looks cheap. Low share price, low PE, beaten down, oversold. Everyone hates it, and you feel like you found a bargain. But Graham taught a very specific kind of bargain hunting. He wasn't looking for cheap-looking objects. He was looking for a discount to value with a margin of safety. A low price is not a margin of safety. A low PE is not a margin of safety. A scary chart is not a margin of safety. Margin of safety means the business can take punches and still stand. It means the balance sheet isn't fragile. It means you're not betting your future on one optimistic forecast. Think of margin of safety like a parachute. Nobody buys a parachute and asks, what's the cheapest possible one? You want the one that still works when things go wrong. So here's how value traps happen. In plain English, a company looks cheap because earnings are temporarily high right before they fall. Maybe a cyclical business has a boom year and the PE looks low right before the cycle turns. Or it looks cheap because the market is correctly worried about debt and the next recession turns that debt into a crisis. Or it looks cheap because the business model is eroding quietly, customers leaving, pricing power fading, until one day the cheap valuation becomes the new normal. Let me give you a mental picture. 2 companies, same price tag on the shelf. Company A looks cheap at 6 times earnings, but it's carrying heavy debt and its profits have been shrinking. It needs the world to stay calm and rates to stay friendly and customers to behave. That's not a bargain. That's a fragile machine. Company B looks expensive at 18 times earnings, but it has modest debt, consistent profits across ugly years, and real pricing power. If the market mood collapses, it can keep operating without begging for finance. That might actually be the cheaper business, because the risk of permanent loss is lower. Graham's world was full of companies with assets you could touch, inventory, receivables, plants, cash. Our world has more intangibles, more platform economics, more buybacks, more financial engineering. That doesn't make Graham obsolete. It makes his insistence on strength and conservatism even more necessary. Invoice number 5 is the most human of all, the panic invoice. This is the one Mr. Market hands you when you're tired. If you've read The Intelligent Investor, you know Mr. Market isn't a chart. He's a character. He shows up every day and offers you a price. Some days he's euphoric. Some days he's depressed. And Graham's advice is simple. You don't have to agree with him. You can ignore him. You can use him. But here's what low-budget investing often does. It leaves you with no buffer, no plan, no allocation, no cash for emergency. So when life happens, car repair, medical bill, job uncertainty, the market's mood suddenly matters a lot, because you might be forced to sell. And when you're forced to sell, you're not choosing a price, you're accepting one. This is also why starting late feels so terrifying. It's not only the calendar, it's the fragility. If you start late with an all-or-nothing portfolio, you're not just late, you're exposed. A bad early drawdown can change the whole path. That's called sequence of returns risk, and it's real. The defensive answer isn't panic harder. The defensive answer is build a plan that can take hits. That is how normal people get crushed in a crash, not because they didn't know stocks go down sometimes. They knew that. They get crushed because they designed a portfolio that only works if nothing goes wrong. Graham would call that speculation too, not because you bought a risky stock, but because you built a fragile plan. Now let's do something different. If you want to invest on a real budget, the kind that actually protects you, stop asking, what's the cheapest product? Start asking, what's the cheapest way to avoid ruin? That's the defensive investor mindset. And it starts with a decision most people skip because it isn't exciting. Asset allocation. Graham was blunt about this. For the defensive investor, the core decision is not which stock is going to double. The core decision is how much you allocate between common stocks and bonds or cash-like assets, between growth and stability. So you can survive, mister. Market's mood swings. In Graham's era, he often discussed keeping both sides meaningful and not letting either stocks or bonds drop below a floor. The exact numbers are personal. Income stability, time horizon, temperament, but the principle is timeless. You build a portfolio that you can hold through a storm. Because if you can't hold it, it doesn't matter how good it was on paper. This is where the middle-class investor gets a huge edge, ironically, by being boring. Boring is underpriced. The market is full of people trying to turn investing into entertainment, day trading options, 0-day to expiration bets, leverage, constant top 10 stocks lists, reacting to every inflation print and every Fed headline like it's the final exam. And it feels smart. because it's active. But Graham's edge was never activity. It was discipline plus arithmetic. The arithmetic says your long-term outcome is driven by savings rate, time, costs, taxes, and the ability to stay invested. The discipline says you build systems so you don't have to be a hero. So here's the one-page defensive investor budget I promised. You can write this on a sticky note. You can put it in your phone, but don't treat it like inspiration. Treat it like engineering, like building a bridge that holds more weight than you think you'll ever need, because one day you will. Line 1, protect your ability to hold. Before you optimize returns, optimize survival. That means an emergency fund appropriate for your life, then boring like a high-yield savings account, T-bills, CDs, or a money market fund, depending on your needs. Not because cash is exciting, but because forced selling is catastrophic. Line 2, capture the free money. If you have a 401k match and you're not taking it, you're paying an invisible tax called pride. That match is a guaranteed return you will not find on a chart. Line 3, buy your core with low friction. For most defensive investors, the core is broad diversification, often through low-cost index funds or diversified ETFs, because the market return is already hard enough to earn. Don't make it harder by adding unnecessary cost. Pay attention to expense ratio. Pay attention to turnover. Simplicity is not ignorance. Simplicity is risk control. Line 4, choose stability on purpose. Decide what stabilizes you. Intermediate treasuries, high-quality bond funds, a treasury ladder, cash equivalents, whatever matches your horizon and risk tolerance. This slice isn't just money. It's psychological ammunition. It's what keeps you from selling your best assets at the worst time. Line 5, rebalance like a machine. Rebalancing is one of the only honest ways to buy low and sell high without pretending you can predict the future. When stocks run up, you trim back to your target. When stocks crash, you add back toward your target, not because you feel bullish, but because your plan tells you to. Here's what that looks like in real life. If your target is 60% stocks and 40% bonds, and a bull market pushes you to 70-30, rebalancing forces you to take a little off the table and rebuild stability. If a bear market knocks you down to 50-50, rebalancing forces you to add to stocks when they feel scary. You don't need courage, you need rules. Line 6, only after all that, earn the right to pick individual stocks. This is where most people start, and that's the mistake. Stock picking is the dessert, not the meal. If you start with dessert, you get sick. Now, if you're going to pick stocks the Graham way, I want to give you a filter that will save you from 80% of the cheap ideas that are actually expensive. First, strength before cheapness. Graham cared about the balance sheet like a builder cares about the foundation. You want liquidity. You want manageable debt. You want a business that doesn't need perfect conditions to survive. Ask basic question. Can this company pay its bills without begging the capital markets? Is the debt load reasonable relative to its earnings power? Has it survived hard times without constant dilution or desperate financing? Second, earnings stability over excitement. One great year is a story. A decade of reasonable earnings is a business. Graham liked long records because they reduce the chance you're valuing a temporary mirage. If a company's profits look like a heart monitor, huge spikes, huge collapses. Treat it like speculation unless you're truly qualified to analyze the cycle. Third, A sensible price relative to normal earnings. Instead of falling in love with a single quarter, normalize. Look at multi-year averages. Ask what the business earns through a cycle. Then ask what multiple you're paying for that earnings power. In Graham's language, you're asking, what's the intrinsic value range? Not the precise number, the range, because investing is not physics. It's judgment with humility. Here's a simple way to keep yourself honest. If you can't explain your valuation in 3 calm sentences, you probably don't have one. The business earns about X per share through a cycle. A conservative multiple is Y. That implies a value around Z. I'm paying meaningfully less than that. If you can't do that, you're not valuing, you're guessing. Fourth, demand a margin of safety. This is the non-negotiable. You don't buy because it might work out. You buy because even if you're somewhat wrong, you're still okay. A margin of safety can come from paying a big discount to conservative value. It can come from a strong balance sheet plus a fair price. It can come from a durable business temporarily mispriced by Mr. Market's mood, but it cannot come from a tweet, a narrative, or a hope. Now let's talk about the most common low-budget stock-picking mistake I see right now. Confusing price with value in a headline-driven market. When everyone is talking about the same theme, AI, the next platform, the next disruption, the next Magnificent Seven, the next whatever, prices can detach from sober estimates of value. The same is true in the opposite direction during fear. Solid businesses can get thrown out with the trash. Graham's point isn't that you should hate popular stocks or chase unpopular ones. His point is that popularity is not analysis. You're not buying a story. You're buying a stream of cash flows and a claim on assets with risks attached. If you can't explain in plain language why the business should be worth roughly what you're paying based on conservative assumptions, you're not investing. You're renting hope. And hope is expensive. Let's bring this back to Mike. Mike started with low-budget investing. He chose the cheapest-looking moves, free trades, fractional shares of volatile names, constant switching, a pile of deals, a portfolio built from headlines, and then a normal life event happened, a layoff, scare, a big expense. The market dipped at the same time. Suddenly, his freedom fund became a stress fund. He sold at the worst moment, not because he was weak, but because he was underinsured. That is the panic invoice. Now imagine Mike with a defensive budget. He still starts small. He still invests consistently. He still uses low-cost funds for the core because he respects cost, but he's not cheap anymore. He's careful. He has a buffer, so he isn't forced to sell. He has an allocation, so he knows what to do when stocks drop. He rebalances, so he benefits from volatility instead of fearing it. And when he buys a stock, he does it with a checklist and a margin of safety, like a person buying a house, not buying a lottery ticket. Here's the part nobody tells you. The defensive approach doesn't just protect your money. It protects your identity as an investor. Because the biggest threat isn't a market crash. The biggest threat is what a market crash makes you do. Graham wrote that the investor's chief problem, and even his worst enemy, is likely to be himself. Not because you're dumb, because you're human. Your brain is not built to watch a screen turn red and stay calm. So you don't rely on calm, you rely on design. This is why low-budget strategies are costing people money right now. Not because they're poor, because their strategy is underbuilt for reality. Reality includes bear markets. Reality includes layoffs. Reality includes fear. Reality includes hype. Reality includes Mr. Market showing up in a bad mood and daring you to blink. Now, let me give you a simple decision rule you can use starting today. The next time you feel tempted by a budget shortcut, if the strategy requires you to be right quickly, it's expensive. If it requires you to predict sentiment, it's expensive. If it requires you to watch prices all day, it's expensive. If it requires you to ignore the balance sheet, it's expensive. If it requires you to hope you'll figure it out later, it's expensive. A defensive strategy feels almost boring in real time. But boring is what compound interest looks like while it's working. And yes, this is how you compete in a world of hype, algorithms, and noise. You don't compete by being louder. You compete by being sturdier. So stop using low-budget strategies that are costing you money. Stop confusing free with low cost. Stop confusing cheap with safe. Stop confusing busy with discipline. Build the structure. First, survival buffer, capture the match, low friction, diversified core, stability slice, rebalancing. Then, only then, use the Graham mindset for individual stocks. Strength, stability, sensible price, margin of safety, because the market will always offer you excitement. Mr. Market will always offer you urgency. And the most dangerous invoice will always be the one you don't notice until years later. If you want to be the kind of investor who doesn't just survive the next crash, but uses it, you don't need a new prediction. You need a better build. The goal isn't to be clever, it's to be unbreakable. And if you keep that one page in your life, protect your ability to hold. Keep costs low. Keep taxes sensible. Keep a plan. Demand a margin of safety. You'll wake up one day and realize something that feels almost unfair. The market never needed you to be fast. It needed you to be steady. One last thought, especially if you're thinking, this sounds great, but I'm starting with $50 a week. Graham's philosophy was never about the size of your account. It was about the size of your errors. Small contributions done with low friction and high discipline beat large contributions done with chaos. In the short run, the market can feel like a voting machine, loud, emotional, obsessed with whatever is trending. In the long run, it becomes a weighing machine. It weighs earnings, balance sheets, and the price you paid. So go back to that no-fee app. Keep it if it helps you automate. But stop letting it turn your retirement plan into a casino. Stop paying invisible invoices just because nobody mailed them to you. Your budget isn't the enemy. Fragility is. Build sturdy, and time will do the heavy lifting. This is Benjamin Graham Investing. Educational only, not financial advice. If you want the next step, the next video will go deeper into a modern Graham-style checklist you can apply in 10 minutes. So you stop buying cheap and start buying value.